by Patrick Reed from Adamas Principal. He's been an institutional trader for the last 15 years, and today he's a very special guest on this channel, and he's going to talk about his personal Forex journey. We're also going to be doing a little bit of a question and answer, because I know that some of you are really excited that I was going to be speaking to Patrick, so you sent in your questions. And then at the end, we're going to be talking about a strategy which we both used when we first started trading. So I thought that was very interesting that we both used this strategy. So at the end, we're going to be telling you what that is. Now, welcome, Patrick.
Hi, how are you?
I'm really good, thank you. How are you? So you're in Dubai at the moment, aren't you?
I am. I'm in next to the pool, and it's a bit hot outside. So I'm in a little cafe in the hotel where I'm staying next to the pool. So hopefully you can hear me and see me okay.
I can hear you and see you okay. I've also changed my office, so I'm going to be by the main road for a little bit. So if you hear lots of cars, then that's why that is. So we've both got a little bit of background noise, but hopefully that doesn't cause too much of a disturbance. Thank you so much for joining us today, even though you are away in Dubai. I know everyone loves to hear about the Forex journey of traders, especially when they're first starting out, just because it's a little bit, I suppose it kind of gives them an idea of where they can expect to be. So I think that's why they like to hear it. So it's just things like, you know, how did you learn? What was your journey like? And I think the big thing that everyone also wants to know is like, how long until you become profitable, and is it worth it? Because I know when you first start, a lot of people feel perhaps a little bit disheartened, or they feel like maybe it's a bit of a struggle in the first year. So I think people just like to hear success stories, and obviously you've been doing very well for about 15 years. And also I think what's really cool is that you've got a completely different journey to me. So I'm a self-taught retail trader, whereas you've worked at institutional level. So I feel like, oh, you have a little bit of a different story to tell people. So I would love to hear what your journey was like. How did it all start? How did you get into trading?
Thanks, Caroline. I guess I really had a fascination, really like most people, watching Wall Street and, you know, all of that stuff. And I sort of had this curiosity to think, is it like the real life? You know, so I watched Wall Street. I was fascinated with anything to do with, you know, stock market at the time and how markets moved. And I was always curious to know what separated the winners and the losers. And I was like, well, surely the winners, they're really smart, and the losers, they're just dumb. And that's not really always the case. And one thing I did sort of come to was a fork in the road where I wasn't young. I was in my late 30s, and I had this really cushy career, and I was like, you know, I had no trading ability, no trading knowledge, rubbish at maths, knew nothing about economics. I was slow, and I thought, you know what, I'm just going to do this. This is the only chance I'll get in my life. And basically what happened is I met somebody whose husband was a massive prop desk trader. I, for some reason, just said I want to meet him. So I went to the old NatWest Tower, Tower 42 on Broad Street, just near the Bank of England. I went up to the third floor and saw all the screens and the noise, and the squawk, and the Bloomberg, Reuters, and I was like, I want this. Just sign me up. I'll do whatever it takes. And so we went out for dinner, and then, you know, we just discussed what to expect. I had saved a bit of money from the career I was at, and I was like, look, yeah, he liked to hear what I was asking, which is really what you need, is a lot of curiosity, even if you don't know that much. So yeah, I jumped in, and you know, I remember, you know, my first day, I just assumed everyone wore suits, and that was the first mistake I made, because I went out to get a very smart suit. Didn't particularly fit me that well, but I bought it, and I paid a lot of money for it, and I was the only one in a suit. Everyone was wearing jeans and t-shirts, and I was like, oh my god. So yeah, I just learned from the ground up, you know.
I would have assumed that they would all be wearing suits as well. Are they not?
No.
Okay.
So I think on the institutional side, if you work if you're client facing, then yes. If you work in a bank, probably all the bank traders generally take their ties off, so they look quite smart, but they do tend to take their ties off. If you're in a hedge fund or a prop desk, no, because essentially it's quite secretive. You don't get public coming to see you. You're not client facing. Often you trade your own money, or if you trade the hedge fund's money, it's like pretty much like the Big Short.
Yeah.
So it really no you and essentially it's not because they're hippie or it's a cool thing, like in a kind of post Shoreditch way. It's to be as comfortable as possible, because when you're on the desk and you've got 12 screens, you've got a lot of noise, and you've got your finger on a button that, if you do click, could result in losing or winning a lot of money. And you just need to be completely comfortable, and that's why.
And so how long did it take you then? So you managed to get your foot in the door, you managed to get work as an institutional trader. How long did it take you until it started to feel like it was worthwhile? I mean, did you feel a bit like out of your depth at the beginning and then you eased into it, or how did it go?
Yeah, I felt very out of my depth and it was almost like it took me a year, basically. I devoured everything. I mean, this was my life for an entire year, because I knew that was my first and last chance at being an institutional trader. Yeah. I was like, okay, I just want to learn from the best. I had to make huge sacrifices. I woke up at 5:30. I left my house. I lived in Ladbroke Grove at the time. I left my house at 6. I was on the desk by 6:30, ready for the Bund Open at 7 in German debt market. And then, I traded. I tended to leave around 4:30, so I didn't want to, go too late. And that was my gig, and it was just so painful and so hard, but I survived. And generally, what you're finding on that level is you'll get knocked down, you pick yourself up, you get knocked down again, you'll pick yourself up, and you'll discover a whole new meaning of pain. I mean, I just cannot stress this enough, but you really will discover how to manage your risk, and that is the key thing. So all the top guys I know are amazing risk managers.
Right.
They're good at macro, they're good at technical, but they're amazing risk manager. And I remember the guy that, one of the guys we used to call him King of the Bund, and that's a German debt, 10-year debt. He used to trade a lot of Bund, and the Bundesbank used to call him up to ask him what positions he had when he was on the floor at life. And we used to sort of say, look, how are you managing your risk? And he'd say, well, just, go easy, know what you're about to lose, manage your trade, tweak it, manage your, understand the liquidity risk, understand, calendar risk, understand, don't go too far too deep. And it's a learning process. Markets can be irrational far longer than you can remain solvent. I think
I know that way.
Some famous economists, and it's so true, right? It's so true. So I did that year, and I didn't blow up. And basically, you generally you'll chug along, then you'll go exponentially, and that's what happened to me. So in my second year, one trade pretty much paid for the year, and then the next 5 trades I did really, really well. And in my second year, I made a lot of money. And it was so worth it. But I just, I needed that amount of time. So I knew pretty much nothing before. So I needed that mentoring and that just exposure to proper markets. And having, just understanding macro as well, just, and technicals that work, just all of this together, because I was kind of bombarded with all kinds of stuff. I mean, one of the things I had to deal with at the time was the Greek debt crisis, and that, I'm telling you, that was not fun. You could trade the right way if you're long or short Eurodollar, but even so, you could have been knocked out because volatility was right off the charts. So it's just dealing with things like that. And but was it worth it? Absolutely. It's completely changed my life.
I was just going to quickly say, so you mentioned macro. As a lot of the viewers on my channel are beginner traders, when you say macro, so it's just to clarify for them that you mean fundamentals, so you mean like fundamental analysis. So I think actually you've also got Adamas Daily, which is something that you actually do in the morning. So I just thought actually just quickly while we're talking about that, could you just let my viewers know what Adamas Daily is and how that can benefit people?
Yeah, absolutely. Each morning to our clients, we give a live 20 to 30 minutes macro breakfast. So essentially in the show, we discuss all the hot topics, all the tradable macro, all the data, all the key geopolitical events coming up, what to watch out for that week. And obviously we do the technical levels as well. And we just really focus on what markets and how the market is interpreting massive, big statements of central bank policy, from obviously the Russia-Ukraine crisis to just the humble jobs report from the US, for example. So all of this is delivered to you live, but also in your inbox around 8:30 Monday to Friday. Now, the difference with what we do at Adamas Daily is I've used to be retail and now I'm institutional. I can talk both languages. So what we tend to do and what we find ourselves doing is dissecting and making the complex narratives into digestible, simple narratives so you can actually trade off those.
What would you say? Because I know this is a question that I get asked a lot, and people, and I think you've got a similar view on it as I do, but it'd just be good to hear, like, what do you think, I mean, in terms of fundamental versus technical, where do you stand there? Because that's one of the things that, when new traders first start, they kind of just want really binary answers to things, but I think I know what you're going to say, but it'd just be good to hear it.
Yeah, so if anyone asks me, like the only answer is this: you need both, right? So essentially, if you get a trader that only trades technicals, they've only got half the picture. Technicals define risk. Macro, you cannot define risk, but macro actually moves the markets. Now, when I say macro, I do mean geopolitics as well. So it's not just the data, it's not just the fundamental. You need both, definitely. I would say, you can trade off technicals, that's fine. You can't really trade only off macro. That's why if you have a technical and you want to kind of up your risk or up your size, get some confluence, get some time frames in, but get some really strong macro ideas behind it, and then go for it. I mean, that's why it's so good, because they're both very, very different. And there are some people, certainly I've got friends who are technicians that talk a completely different language. I mean, some of them were head of technical analysis at JP Morgan, Morgan Stanley. They've got all of these letters after their names, and that's great, but that doesn't help you get a macro view, which you really need. So I would just say absolutely both are essential.
Yeah, so I mean that's kind of what I think as well. So my view on it, and I don't know if you agree with this, but I believe that ultimately macro fundamentals will pick the long-term direction, and I think technicals are better for shorter term, but ultimately the fundamentals move the market, so like that's the long-term direction. So I mean that's kind of where I stand on it. So you kind of have to take into account both, and obviously fundamentals will override technicals if something big is going on. So that's kind of, I mean, do you agree with that?
I would mainly agree with it, but what I would say is if there's a new bit of data that gets released that changes everything, then you will get a quick move. So it's not really long term.
Yeah.
And if that's, say, non-farm payroll, that let's just say we've got 1 million next non-farm payroll, you're going to get Eurodollar come off, say, at least 50, 60 pips. That will be like probably take 10 seconds. So that's fairly quick. So it's not really long term. But if you have a broad view, like the US macro picture, then absolutely yes. And look, talking about the US, for example, the macro picture, the fundamental picture is largely pristine. So you kind of, your bias is kind of buying dollar dips,
Mm.
but that's where the technicals come in into their own. But it's like, if you're a dollar bull, if you've been a dollar bull this year, it's very hard to go limit in your risk, because you would have been stopped out. I remember last year, Q1 on the dollar index was up 4%, Q2 down 4%, and then it was on a nice rally. So, you use technicals to manage that risk and not add to a losing position too much. So yeah, it is. You're right, and if I know that the Fed's going to be top central bank to be hiking, which they are at the moment, I just think, well, why are they doing that? It's because of the macro picture. Therefore, I'm naturally biased to be looking at dollar upside. So yeah, so that would be my kind of default setting.
Okay, wonderful. So just a few quick questions. I know that a lot of people that watch this channel are newer traders, so a lot of them are sort of wondering things like, how long did it take you? I think you said it took you about a year. Like, what would you say in terms of your profitability journey? Like, how long did it take you until it was very much worth it? And was there moments when you thought that it wasn't worth it and you ought to quit? Throw it all in?
Yeah, loads of times. I just the thing is with this whole Instagram, YouTube crowds, and trading's not easy. If it was easy, everyone would be doing it successfully. And you see that thing about 78% of retail traders lose money. Well, there's a reason for that. Most of them are lazy, right? I'm just going to put it out there because they are. If you do work with an institutional trader, and I've worked with a lot of very big guys, and girls too, that their work rate is insane. Like they'll put in 15-hour days because they have that passion. And the thing is, when you get it right, it literally changes your life. Like, I mean, it has done with me, and it's done that for a lot of my friends. And essentially, you got to put the work in. You just do your own research and pick yourself up, learn, and basically, don't look at all of these Ferraris on Instagram and all that stuff. All of that's fake, right? So it really is. And all I would say is, one of the things I will say is, whatever you're at in your knowledge, grit, it is definitely perspiration, not inspiration. And grit is your best friend. It really is. Risk management and true grit, because, there were times in that year. I mean, I had good days, I had bad days. I survived the year. That's what I say. I started with X amount and kind of finished, with slightly less. But you know what? It was a learning process, and I got the knowledge and the education to actually make so much money later in my second year that it is completely flatly changed my life.
So that actually brings me really nicely on to my next question. So this is a discussion that I was having with one of my clients this week, and we were actually talking about the amount of time that you need to put into it as a retail trader. And I said that I think that actually a lot of people, when they first start, they do get sucked into the Instagram things. They kind of get sucked into the whole working 15 minutes a day, making, spending the rest of the day on the beach, all of that thing. And I think what I said to them was, actually, it's a job. You have to treat it like a job. So, I mean, although there is a little bit more freedom as a retail trader, you still have to put in the hours. And, I still have all my alarms, all throughout the day of when I have to check charts and when I have to do certain things. So I was like, sure, that interrupts me if I'm doing something. But, you do have to put in the time. And I was just wondering, what do you think in terms of being a retail trader? Realistically, what do you think is the amount of time that people need to put in order to be successful at it?
Well, it's ebbs and flows, and it depends on how much you know already. So, and it depends on what's affected markets. So I'll give you an example. I'm all over Japan, right? Because we had this huge explosion in dollar yen, and it's affected all the end crosses. There's a lot of talk about the Ministry of Finance, the MOF, and also the BOJ, talking about intervention. So in the last 3 weeks, I've just spent at least 8 hours a day just poring over white papers, poring over government documents, looking at the bigger timeframes on risk, on the technicals, talking to people that are closer, on the ground and stuff like this. And, I do that in the daily show as well. I distill all that and make it a tradable action. But what I would say, this dollar yen move doesn't happen all the time. So for me, I had to do that whole year so I can now, in the mornings, usually I spend like half an hour. I put my bids and offers in, check my phone for any news coming out, and then go about my day. And at the end of the day, I just check my orders. If I've got filled, that's fine. If I've got stocked out, that's fine too. If something's kicking off, like a war, for example, I'm all over it. You can't get me away. But generally, I'm not, because I don't trade futures now. When I was back then, I was just almost like lived under the desk. So coming back to your question, I think it depends on, your work rate and how quickly you can get into, you can ingest the information. But I would say in the very beginning, just treat it as a 9-to-5 job until you feel comfortable in, knowing what macro is, knowing the key bits of data coming out. And what I tended to do is, I was like, when I first started learning about macro, I was like, well, what country do I start? And I started in the US. And, that's my little speciality because I love US macro. I live there and stuff. So I would say start with one country, learn it inside out, and then build on that. But yeah, in the beginning, it's like a 9-to-5 job.
Right. Okay. So what would you say then for someone who already has a 9-to-5 job and they want to become a trader, a retail trader? I guess it's more realistic for people to be retail traders than institutional traders at this stage. So if they wanted to transition, how would you recommend they do that? I've kind of got my own personal journey with it, which is that I didn't go straight, I didn't quit all at once. So I sort of managed to juggle the two. But is there anything that you would say to do differently? If someone's treating one thing as a 9-to-5 and they've already got a 9-to-5, is there a way to transition like that?
Don't give up the day job, right? Yeah. Try and go freelance, try and reduce your hours, go part-time, take a Friday off, try and have that in your contract. Reskill to a job that's similar money but gives you a bit more flexibility. All of these things, just maybe have a chat with your boss and go, look, it depends if you're in the industry or not, but if you're in a job you don't like, then life's too short. So if you can't leave your job whatsoever, you just got to do nights. There's like, you get home and do it, but trading is always like, when somebody asks me why I wanted to be an institutional trader, I'd always say because I want to make shed loads of money. But it's kind of true and it's nice, but the real successful people do it because they love it. And it's not about the money, it's about winning, which is different. It's about the passion. And you know what? I could do this all day because it's like, if you ask Messi or Ronaldo, oh no, you've got a football match. Oh, such a shame. They'll be like, it's like the football's glued to their feet. They love it. It's like, and that's why they go and put the training in. That's why they grind. They perfect. That's it's the same with any skill. But when you do get the bug and you get bitten by the bug, it's like it is an amazing thing because it just opens up. Since I've been a trader, I know more about politics and what goes on in the world than anything else, really. So it's really, it's so interesting. It's really fascinating. So.
Yeah, I was surprised actually, to be honest. When I first started trading, I thought that it was going to be this tedious, boring thing that I was going to hate. And I'll be honest with you, I got sucked in because of the money. I thought, I needed a way to make more money than I was making. And I thought, okay, trading will be it. But I actually realized that I loved it, and that was, I got sucked down the rabbit hole. And I was glued to the charts all day. And luckily I was kind of in a job where I didn't have to, I could look at my phone and I could look at the charts, and I able to do that. But I know, like, there's a lot of people that they've got jobs where they can't do that, so it's a little bit different for other people. And I was going to ask another thing. So this is something that I'm always getting asked by people. What do you think is a good amount to start with to trade, like as in your trading capital? What do you think is a good amount to start with? Do you think it's worth people starting to trade if they have a small account or they don't have access to a lot of money? What's your views there?
I can tell you what I started with. I started with 50. So that's more than enough.
Yeah, 50,000.
Yeah. Yeah, so that's kind of the standard for a futures desk, for an institutional desk.
Yeah.
And that was my own money. Obviously, I had a bit saved up. But, I had rent coming out of the desk. I had, all kinds of infrastructure I needed to pay for. But I had an institutional seat. So, I could do some size there. So that's essentially what you pay for. For a retail trader, I would say minimum 5. 10 is probably a decent figure. But for me, it's not about the amount. It's about your clip size and your margin as well. So
just quickly, there will be people watching this that think you're talking about £5 or £10. So he's talking about 5,000 or 10,000, just to make that clear. It's nice to get to that point when you're talking in those kinds of numbers. But yeah, I know there's people that will be watching this. They're like, can I start with £100? And I always say, like, you can. You're not going to make any money. You're not going to turn that £100 into $1 million. But obviously, I just
yeah. So that's it's good to clear that up.
They'll be like, great, I've got
£5. Yeah, I would say maybe save it and just build and go on the demo. I think in real terms maybe 5,000 or 10,000. But you know what? It can be 1,000. As long as you're only using 20% margin. So generally, if you get an amount, and this was taught by me by some institutional traders, you get 100%, which is capital. Out of that, you get 20%, which is your margin. You can only really use that 20%. So if you have 1,000, obviously you can only use 20% of that, and that is all. That means that when you hit your margin, get a margin call, you walk away with 80% of your capital.
Yeah.
Right. So if you do that, you're not good enough. And that's the key thing to remember. You're not good enough. Right. So you can have 30% of your capital, whatever. And my margin, I set myself as 20%. In March, I was down nearly 5%. Bounced back quite well in April. But if I started nibbling away at my margin, and I hit 20%, I'm done. That's the realization. The big Patrick Reed is done, and that's the thing. You see hedge funds blow up all the time because Archegos. You see loads of things about. There's a great story about Tiger Management, which is probably the godfather of all hedge funds. Julian Robertson. He shorted the dot-com boom in the 2000s. He shorted billions. He lost like 1.6 billion. Right? He is a prolific trader, one of the best. His Tiger Management spawned about 100 hedge funds. Right? He's huge. So he was shorting. He had to close his position. He lost 1.6, maybe 2 billion. A week later, there was a crash.
Oh,
yeah, and that was a dot-com crash. Yeah, yeah. The FT, a week. The FT did a great story on him, right? And that, it happened to him. He's like far cleverer than I will ever be. So that just goes to show you've got to be in charge of your risk, because even if you're smart, even if you're a NASA scientists, and a lot of these hedge funds, they employ ex-NASA scientists, by the way. Even if you're so smart, just manage your risk.
And also another really good point that made me realize was, this is one thing that I always say to the new traders when they first start out, is that it's really easy to get the direction, but it's the timing that's difficult. So like it's really easy to look at a chart and go, I know where it's going up, but it's the exact timing. You're going too early and you end up getting stopped out. It's like the exact precision of the timing, which I think is almost one of the key things as well. And that story kind of sums that up as well. Like, you got the direction right, you just was a little bit too early. It's not good to be early. And that's the thing, is another thing I think that a lot of new traders, you know, I talk to a lot of new traders, obviously. That's one thing, is they see an opportunity and they want to get in as soon as possible. Yeah, I think that story kind of sums up why you don't actually always want to get in as soon as possible. You kind of want to get in at the right time. So I've got a couple of questions that have been sent to me from a couple of my clients. They were very excited that I was going to be talking to an institutional trader. One of the questions that I got asked was, do institutional traders rely on the stupidity of retail traders? No. Yeah, no. Okay, so
we don't care.
Okay, so this is a rumor which is doing the rounds, but yeah, no, that's interesting. There we go. We've got the very short answer there. They don't care.
Banks don't care. Banks don't hunt stops. I mean, sorry to interrupt. I know, I can read the market, and I know where you might get some weak stops. So I'll be a buyer when there's a weak seller. But you know what? Nobody cares. I mean, algos might hunt some stops, but to be honest, in spot effects, it's so deep, you can't really do much out of that. So yeah, the banks have not enough on their plate to worry about where all the retails. Let's get all that money off the retail. Yeah, no, they've got more conflicts.
That's so funny. Okay, so that story that they stop hunt very nicely explained why your stop loss always gets hit, and then it goes in the direction that you knew it was going to go in anyway. Do you have a more logical, realistic explanation as to why that happens then, if it's not?
Yeah, your entry's in the wrong place, right, and your level isn't very good. So generally, I'll give you an example. Aussie dollar, 73.96, right? Call it 74. I shorted that yesterday, right? It came off like 50 pips. I took some profit. Then I got stopped out, right? So it happens. I've been around 15 years. It happened, but I still made money, right? So that's the key thing. If it bounced off and went down again and went up to that level, would I still sell it? No, because we're done. It went through the level. So that's the key thing to remember. It's not really, it's your entry, but it's not really, it's how price reacts into that stock. So, you know, the next level on Aussie dollar for me is 75.00, right? So is there enough fresh open space and clear rejection from that level the last time it met it? Yes, that means it's a really good level. If price is hanging around like a bad smell, going up and down through that level on previous times it tested it, no, it's not. I'm not getting it involved, because that means that the level's been softened, and that means you're going to get some weak entries in there. So those are the little tricks I recommend you take on board.
And another one is it actually worthwhile to check the commitments of traders? You know, on CFTC. There we go. We've got another. Okay, what's your reasoning? This is another thing that we're always told. You know, check CFTC.gov, check the commitments of traders. Obviously, they're only updated every week, so you kind of know that they're not going to have any sort of short-term impact. But you think even long-term, they're not worth it?
No, I used to. So I used to trade futures, right? So essentially, they're lagging, right? And all they tell you is what traders in 3 months' time are trading. That's it. So what I would say is never use them as an indicator to a position that you may take right now. What I would say is if you are in a position and you see the opposite on the COT, line that up, take a bit of profit. It just makes sense, but never use it as an indicator. What you might want to do is just to, if it's complete opposite, just take some profit because, maybe, in 3 months, which is essentially what it is, it's 3 months futures, there may be a bit of a change in sentiment. But, I would definitely use it that way, not go, oh my God, well, I think you'll find the commitment of traders say this, therefore I'm going to base my entire portfolio on a lagging report that got released last Thursday that's in 3 months' time. No.
Okay, and that actually brings me nicely on to my next question, which is it worth checking what the retail traders are doing? Because you can also see on the cftc.gov, you can see what the retail traders are trading. And because we know that the majority of them are, lose money, is it actually worth checking what they're doing and doing the opposite? Or is that same thing with lagging indicator?
Yeah, so only if you're a broker and you're going to make money out of other people's pain, right? So focus on yourself. Don't worry about what everyone else is doing. Do your homework and split your risk, put your hard work in and forget anyone else, because this is a lonely job and, you're never, ever going to learn. This is why I don't believe in copy trading and MAM accounts and all this stuff, because it creates laziness, right? So, essentially, we'll do this interview. I'll go home, have an early night, wake up tomorrow morning, and I'll do my own work, right? And I might be wrong, might be right? But my probability is if I've done the work, I don't really care because I've managed my risk. And the thing about that is I feel I'm not going to copy somebody else. I'm not going to go, well, the sentiment swingometer for a small part of the universe, which is retail traders, says this, so therefore I'm going to do that. No. And
I was going to ask you about signals as well, because I hate them.
Yeah.
I hate them, and I hate people asking me them. I tried to do them, and it was a horrible experience. So I was going to ask you, because that's new traders love signals. It's the lazy way, though, isn't it? It seems like a cheap way to make money. Okay,
so I'll ask you this, right? If these signals are so good, why don't the people who sell the signals, why don't they just print their own money, right? It's the goose that always lays the golden eggs. Why do you think they're doing this out of the goodness of their heart? They're giving you the signal so you can print the money and lay the golden eggs. No, right? So you think, well, why are they doing this? Are they just got a good heart? Are they really generous? So they don't work.
I also think it's impossible, like even with the best of intentions, it's impossible for everyone to receive the signal at the same time. And to, everyone's got different accounts, they've got a different, risk appetite. And so I just find it's impossible to send one signal out to hundreds of people and expect that everyone's going to get the same result.
I mean, I would just say, don't be put off by, it's not them and us on the retail versus institutions, because I met, I think we were talking offline about fat fingering, and I've met some institutional traders who are very good, but they made ridiculous mistakes, and they don't know everything. Banks and hedge funds do not know everything, and I've worked with them, right? So, I haven't worked in a bank, but I've worked in hedge funds, and I've worked in a prop desk, and I've met a lot of those guys, and they're just human, right? They make mistakes. They may do something which is called an edge. They may do it really, really well, makes them a lot of money, but they're just human. Everyone today, especially with this, so much information out there, everyone today has got a really good chance. You just got to put the work in. And also, if you're a retail trader and you want to dream about being an institution trader, dream. You can do it. I did it. I put the work in, but I did it. So, you can do it too. You just have to work hard.
So what's the best way, if someone did want to become, go from retail trader to institutional trader, what would you say was the best way for them to go about that? Because I know it's not necessarily, you kind of need to have a way in, don't you, unless you want to start at the very bottom. So what would you suggest to someone if that was their dream?
it depends on what you want to do. Banks usually require at least an economics degree, preferably an MBA, and then you do summer intern program, then you become an analyst, an associate, and then you work your way up that way. It takes quite a long time. We actually do place people in prop desks if you do our one-year course, the Absolute Masterclass, which is, absolutely, if you want to know more details, we can certainly reveal those. Essentially, if you want to be in a proper prop desk, like a futures desk, like I did, you would have to get introduced, and we can certainly help you. So yeah, I would just say, do your work. If you want to do that, drop me a line, or we can have a conversation. We can certainly have that conversation and get you there. But anything's possible. If you can talk in dollar terms and risk terms, like that will open up a lot of doors for you. I haven't got an economics degree or a maths degree, and I regularly talk through platforms like LinkedIn and stuff like that. Regularly talk on the phone as well to very high level people within the institutional space, because I know I can talk in dollar terms. I have a market view. I know my macro, and I know what my risk is. So yeah, anything's possible.
So I'm going to link in the description below the link. So if anyone was interested in signing up to Adamas Principal, because you mentioned there that you are able to get people in that way. So I'll link in the description below, and then just any information. So if you are interested in that, then you can just click there. Also, we were going to talk about a beginner strategy, which we just happened to stumble across the fact that we both use this. I thought I made it up. Turns out I didn't make it up. It was actually a thing that people do. But I thought that was really interesting, because I felt like when I first started, I thought I was cheating, because I worked out a way that if I missed the big move, I was then still able to make money. And I'll be honest, I still use this. I still use this strategy, because sometimes, if I do miss a big move, for example, if I'm teaching people, or if I'm doing something else, so that does still happen, and I do still make the most of this sometimes. So we were talking the other week, and you told me that it's actually a thing called fading. So how would you explain fading as a strategy?
Yeah, so fading is basically going against the market, and it basically, if the market moves much higher or much lower, you disagree. So call it contrarian. If you the other way of saying it's revert to the mean. So essentially, you're in disagreement with the market move right there and then, and what you're hoping to do with a fade is, as you say the market moves higher, say euro dollar moves higher, you're selling into that strength, right? So then you're anticipating the market will come back down after the move. That's essentially what a fade is, and the same thing goes if euro dollar goes lower, for example. So you're essentially going against the market. You don't agree with the move. You think it's overdone. You're being contrarian, and you have your reasons. And all that sounds really nice and easy and simple. It's not, because if you did that with dollar yen at 113, then you would have been in trouble, because we're now around 128. So it does require the utmost patience, and you've got to be a very, very good risk manager as well. So you've got to start very, very slowly. And generally, when I fade something, and a fade is common in institutional desks, right? So I would always write my risk down, write my spread down, and go, look, how much am I going to add here? I'm going to wait for it to go another, say, 30 pips, add a bit more, and always have a hard stop as well. Write the risk down, and what you'll find is when you write the risk down in each leg of that clip of your trade, amazingly, you'll write it all down, you work out the P&L, and it's a lot higher than you think. Yeah. That's the key. That's the key, because you're like, oh, well, I'm only doing 25% of my normal clip size. But it does mount up because of the spread. So it's like, right, okay, I didn't realize that. And the only other tip I have on fading is never double the amount you're fading in. Always have the same amount of clip size. because that can take you, that's a one-way ticket to the poorhouse.
Do you know what's really interesting? You said if you faded dollar yen, you'd be in a lot of trouble. But funnily enough, I actually did fade dollar yen, and I think I made about 100 pips on it. So that, but I thought this is why I think this is when we had that conversation. I thought it was so interesting because you actually got it on the move up, which is, you know, you are a true professional, so you got that giant move up, and you made it up over 100 pips on that one. And then I missed the move up, but I saw that it was coming down. So there was a little bit, it's continued to go up. So my thing with fading, or how I teach it, is be very quick. Like, it's not a long-term position. It's just like a short move that comes down. So don't expect to be holding it for days and days and days. You literally just want to be in and out. And I always say, close it before you go to sleep, because you don't want to go to sleep and wake up at a massive loss.
I think that's excellent advice. And actually, maybe there's another seat available for you, Caroline, on the institutional prop desk. That's very good advice.
Good. Oh, I'm glad. Is there anything else that you think would be worth anyone else hearing before you sign off?
No. Look, if you want to hit me up on LinkedIn, it's Patrick Reed, the Adamas Principal. I'll leave you all my details, and it's a real pleasure to see you again, and happy hunting this week.
It was so good to have you on. Thank you so much for taking the time out of your trip away to Dubai. We really appreciate it. And hopefully we will speak to you again soon.
Thanks a lot.